Hello everyone, I'm Dr. Vidya, Assistant Professor from Kristu Jayanti Institute of Management. In today's video, let us discuss about leverage analysis. Leverage analysis is an important concept that helps us in taking important corporate financial decisions. Moving ahead, let us understand what does a leverage mean. A leverage is nothing but refers to the employment of different sources of capital, that is debt plus equity, with an objective of optimizing your fixed operating and financial cost so that the firm can control the cost and maximize the profit. Leverage, the term arises due to the presence of a fixed cost asset, interest bearing fund, and etc. that do not vary with the level of output. Moving ahead, let us understand the importance of leverage analysis. It helps us in assessing the risk. Now, it determines if a company can meet the debt obligations and identifies potential insolvency risks. It helps us in measuring how efficiently a company can use the debt in order to increase the return on equity. It helps us in capital structure optimization. That is, leverage analysis helps us in identifying the ideal mix of debt and equity to minimize the cost of capital and maximize the valuation. Then it also helps us in understanding how sensitive a company's operating income is to the changes in the sales volume. That is, as the sales volume changes, how does the operating income or the net income keeps changing? As informed earlier, it also helps us in taking strategic decisions. Right? It assists the management in deciding whether to expand using debt or help the investors evaluate the stability of the firm. Going ahead, let us look at what are the types of leverages. We have three important leverages that are calculated. That is the operating leverage, financial leverage, and the combined leverage. Let us look at each of these leverages. The first one, that is the operating leverage. Now, this particular metric measures how a company's fixed cost structure is going to affect the operating income in response to changes in sales revenue. Now, a high operating leverage is typical in industries like a software or a manufacturing industry, and it means that there are high fixed cost and there are low variable cost, which leads to a significant profit gain when the sales are increasing, because we all know that the fixed costs are not affected by the sales volume. But in case there is a sales decline, there is going to be a little bit of a risk. Now, this particular leverage focuses on operating cost, that is fixed cost in production, and it indicates the operating risk. Now, how do you calculate operating leverage? We have to use the formula, that is contribution divided by EBIT. Now, contribution is nothing but sales minus variable cost, and EBIT is earning before interest and tax. Moving ahead, we have the financial leverage. Now, financial leverage basically refers to the use of borrowed fund in order to amplify the investment returns or the purchase assets. Now, this is generally aimed for gains that would exceed the cost of borrowing. Now, while this magnifies the potential profits, it may also increase the financial risk, because we all know that whether the company earns profit or not, interest on debt needs to be paid, or the debenture holders have to be paid interest on a regular basis. This focuses on the financial cost, that is interest on debt, and obviously indicates the financial risk. So higher the financial leverage, higher is going to be the risk. Now, how do you calculate financial leverage? It is EBIT divided by EBT. That is earnings before interest and tax divided by EBT gives you the value of financial leverage. Moving ahead, we have the combined leverage. Now, the combined leverage or the total leverage measures the total risk, that is operating and financial together, by analyzing how a percentage change in sales is going to affect a company's earning per share. This focuses on the overall effect of sales on the EPS, and as mentioned already, it indicates the total risk. Now, how do you calculate the combined leverage? You have two formulas for this. If you have the operating leverage and financial leverage, just simply multiply these two values and you get the combined leverage. Otherwise, use the formula contribution divided by EBT. Moving ahead, we will just look at the income statement that helps us in calculating the three leverages that we just discussed. Now, in the income statement, we generally have the sales value, from which if we deduct the variable cost, we get the contribution. From the contribution, you deduct the fixed operating cost, you get the EBIT, that is earning before interest and tax. Now, if you look at the operating leverage ratio, it is EBIT divided by, the contribution divided by the EBIT. Then from the EBIT, if you deduct the interest, you get the EBT. So that can be used for calculating the financial leverage. That is EBIT divided by EBT gives the financial leverage. And from EBT, you deduct the tax, you get the earnings after tax, right? And that value can be used to calculate your operating leverage, right? Moving ahead, we will just look at what are the implications of leverages. If the operating leverage is high and financial leverage is high, that is, both the leverages are high, the implication is it's a very risky situation. If the operating leverage is high, financial leverage is low, it again is a risky situation. So the ideal ratio is where your operating leverage is low and your financial leverage is high. This is ideal for profit maximization, and a company should always look out for these particular leverage ratios in order to take important capital financial decisions. That's it for now. Thank you very much.